Today, we're going to talk about monitoring the powerhouse of export finance packing credits. If you're an exporter or an aspiring global entrepreneur or a working capital financier of an export business, stick around till the end as we unwrap the secrets, demystify the jargon, and guide you through the various aspects of running and monitoring a packing credit account. Hi, my name is Yash Shah, and I'm a part of the leadership team at SJA, a 40 years old project monitoring organization on panel with large public sector banks and financial institutions for post disbursement monitoring of large and very large working capital accounts having export limits in certain cases in excess of rupees 20,000 crores. So let's get started. First of all, what are packing credits? Packing credit is a pre-shipment fund-based working capital finance extended to exporters with a stipulated end use of procuring, processing, and packing goods meant for export. This may include purchase of raw materials, consumables, labor costs, and other direct overheads associated with preparing the goods for export. The second question is, how does the packing credit process work? The story of packing credit starts from you as an exporter getting either a confirmed order or a letter of credit established in your favor. Against this confirmed order or LC, you will get packing credit as individual loans, which we call order by order PC, or a single running account, which is generally granted to large export houses. Against this confirmed order or LC, you are extended a loan in your operational account, which may be a current account or an overdraft account or even a cash credit account or an EEFC account for packing credit in foreign currency, also known as PCFC. Now, once you get these funds, you can utilize them through your operational account for getting the shipment ready. Once the shipment is ready, the stipulated export documents are prepared. The commercial invoice, the most important bill of lading, which is nothing but the formal delivery challan, shipping bill, packing list, and other stipulated export documents. These documents are critical, especially if your packing credit is backed by a letter of credit which is issued in your favor. Once your shipment is completed, you get your documents processed through your PC extending bank, and at this stage, one of two things may happen. If your transaction is not on credit, for example, the LC in your favor is a DPLC, your documents get handed over to the importer against a foreign inward telegraphic transfer, which will be used to liquidate your packing credit, and any short excess will be adjusted in your operational accounts. The second thing which may happen is that if your transaction is on credit, which is usually the case, for example, the LC in your favor is a DALC, documents against acceptance LC, your documents get handed over to the importer against a bill of exchange which promises to pay you after a certain number of days, which is the usance period. Over here, you have a further two options. Option 1, you can either get this bill of exchange discounted, in which case the discount proceeds after adjusting the bank's discounting charges, get adjusted against your packing credit advance, and a new loan account gets opened in your name called bill discounting. On the due date of the bill, the bank collects the bill of exchange, closes the bill discounting account, thus completing the process. Any shortage or excess gets adjusted to your operational account. The option 2, which you have in case you have extended a credit to your customer, and this is for cases where you do not need funds upfront in your working capital, you can send the bill just for collection, in which case you will get the funds on the expiry of the usance period after deducting the collection charges, which will obviously be lower than the discounting charges. The packing credit will get liquidated on the expiry of the credit period against these collection proceeds, completing the process. Now, coming to the interesting and important part of this video, what are the important tools for monitoring a packing credit account? Packing credit is a species of a working capital account. In case you have not seen the video on stock statements, I strongly urge you to watch that video first before proceeding further from here. The link will come up somewhere here on the top. Now, for packing credits, the most vital monitoring tools are A. Physical and financial segregation of export stocks and even the units. Do remember that packing credit is a concessional advance which is extended to promote exports with concessional rates of interest and concessional margins. It is important that the borrower, if he is not 100% exporter, maintain physical segregation of his packing credit stocks from the domestic stocks. Similarly, the unit which is processing the packing credit related items should ideally be kept physically segregated from the domestic unit manufacturing. Also, the reporting in the books needs to be clearly demarcated. B. The limit liability overdue statement. PCs need to be liquidated within a stipulated time period through either an FITT, which is a foreign inward telegraphic transfer, or a foreign bill of exchange realization. You need to monitor the overdue statements of packing credits to ensure that no packing credit remains overdue beyond the sanctioned period. Further, excessive rollover of PC, wherein one PC is liquidated against a fresh disbursement, which is in a way rollover without any realization of export proceeds, for no tangible reason on record, needs to be viewed very carefully to rule out the case of evergreening. Point C. The PC pass sheet and the bills pass sheet. As a monitoring agency or a financier, you need to befriend the pass sheets and its various forms which are prepared by the different banks and financial institutions of the country. The liquidation of packing credits against telegraphic transfers or bills needs to be collated and reviewed against the total export turnover being declared by the borrower. Point D. Review of the profile of the foreign counterparty. You should always do a thorough review of the profile and beneficial owners of the importers whose inward remittance and bills are being used to clear the packing credits. This is of vital importance in all export accounts to rule out undisclosed related party transactions, circular transactions, and even kite flying operations. Review of foreign parties, specifically the sources of data, accessing financial information of entities in foreign jurisdictions like say Dubai, Singapore, USA, United Kingdom, Australia is a separate topic in itself and deserves its own video. Let me know in the comment section if you would like to learn how to access this data of foreign jurisdictions for your analysis. Hopefully, the above guide was helpful in understanding the workings and the monitoring framework for a packing credit account. Do note that understanding packing credits in isolation may sometimes not give full clarity, which requires a full discussion of the transaction from both the importer side, the exporter side, and from the importer's bank and the exporter bank, involving the products like letter of credits, bill discounting, export and customs process, which will clarify the entire picture from both sides for you. So if this video on packing credits was of interest and reaches say 1000 views, we will consider making another video discussing and interlinking the aspects of export finance both from the point of view of importer as well as from the point of view of exporter to cover all perspectives and give absolute clarity. So thank you so much for watching, and I will see you in my next video.